Selling options is the closest thing that I know to printing money. It's like dividends on steroids. And I've personally made over $1 million in options premiums alone. And I'm here today to share a crazy new technique with you. Up until now, I've been showing you cash secured puts in red markets. Yesterday, I made a video about a covered call strategy on underwater stocks in a green market. But today, I'm taking it a step further. I'll introduce a bold strategy that I call the cost basis compression play, selling covered calls to reduce your share cost basis when you're way underwater. So let's dive right in. If you're new here, my name is Adam, and I retired in 2024 at the age of 41 years old. My retirement thrives on three pillars. Number one, you got the multi-bagger for growth and asset appreciation. Number two, you take that multi-bag of growth and you buy a ton of high-income dividends for steady cash flow to cover all of your bills. And number three, the options income strategy to turbocharge my passive income with covered calls and cash secured puts to buy yourself the finer things in life. Now, I'm not a financial advisor, and this is not advice at all. Just me sharing my real trades with real money, full transparency, and no fluff. You've seen me manage $1 million marker rolling and wheeling. Check out my past videos. I have a link up above. Like the recent covered call on Robinhood that I put out earlier this week. By clicking the links up above, you're going to make sure that you don't miss a thing, but make sure to come back to this video as soon as you're done watching those videos. Today, I'm going to be completely switching it up to Tesla with a brand new tactic. And like always, rolling and wheeling are your superpowers with covered calls. I'll keep this practical. I'll keep this very fast. So follow the screen and the arrow and let's get into it. Let's start with a quick basics of covered calls for beginners. And this is not going to be a beginner's video. This is definitely an advanced video. A covered call simply means that you own a stock, 100 shares of a certain company, say XYZ, at $50, and you sell a call option giving somebody the right to buy those shares at a certain strike price, say $55, by a set date, call it the expiration date. And for this, you collect a premium. That premium is yours to keep no matter what. If the stock stays below that $55 strike, the options expire worthless, and you keep your premium as well as you keep your shares. But if it rises above the $55, they may call your shares. You have to sell at $55, keeping your premium, but missing out on gains beyond that. It's like renting your stock for extra cash with capped upside, but low risk. You always have the option to wheel, and you always have the option to roll. Now, for today's strategy, this is something that I call cost basis compression play. This is a veteran move. This is not for the faint of heart. It takes guts, it takes management, and it takes cojones of steel. When you're severely underwater, you sell covered calls to collect premiums, synthetically reducing your cost basis over time. What is the goal? To lower the gap between your share cost basis and your strike price, betting on an eventual appreciation while getting paid to wait. It breaks all of the beginner rules, selling below your cost basis, lower premiums, high risk if assigned, but with technical analysis and discipline, it can definitely work. And I'm going to show you, as always, how it is working in real time with my portfolio. Real money, no BS. There's two things that you need to know to make this cost basis compression play work. Number one is basic technical analysis to moderate technical analysis, picking the right strike price using indicators to avoid assignment. I'm going to show you several of those technical analysis today. It's going to be extremely, extremely easy to follow. Number two, no greed. You need to prioritize keeping your shares or rolling out and up if assignment looms, aiming to reach at least your cost basis. So let me give you some tactics and examples of this cost basis compression play. Applying this to Tesla from last week, Tuesday, April 22nd, follow the screenshots and the arrows. My week usually starts the following Monday for when all of my other options ended the Friday before. Friday was April 17th. Monday would have been April 21st. Instead of selling covered calls on Monday because the market was red, I waited for green days. As always, you prefer to sell covered calls on green days, and you prefer to sell cash secured puts on red days. I made a bet that the market was going to recover, and it started recovering exactly the next day. I was right. So I sold 2 covered call contracts on Tesla at a $330 strike, expiring May 16th, collecting $1.60 per contract times 100 shares. That's 200 shares at $1.60. That's a total of $320 for the 2 contracts. My cost basis for Tesla shares is currently at $405.99. Remember, I was buying at a lot of the tops after the Trump pump before all of the tariffs talk and the market gave back a lot of their gains because I made a bunch of multi-baggers in 2024 and then I used that money to retire. So my cost basis on a lot of stocks is actually higher than the share price right now, but that's okay. That's why I'm showing you this specific style and this specific technique. If you're following, that's approximately 0.4% monthly against my cost basis, or roughly 4.8% annually, which is way below my golden beginner rule of the usual 2% monthly target. This small premium adds up across thousands of contracts I sell monthly, turning into real money for me. Tens of thousands of dollars every single month is how much I make selling options. For these 2 contracts, that's a total $320. But imagine that scaled across my entire portfolio. It's absolutely a significant income stream. But what's the catch? I'm actually 35% underwater. Tesla was around $261-ish and $144.99 below my cost basis. My strike of $330 is still below my cost basis of $405.99. It's a lose, lose, lose situation, a triple threat loser. I'm losing on my shares, I'm losing on a low premium, and I'm losing if assigned below my cost basis. I'm literally breaking every single beginner rule imaginable. So why do it? It's simple. I'm so underwater, I need to synthetically reduce my cost basis with the premiums. This isn't a beginner strategy. This is absolutely a big boy move requiring guts. That's a $320 premium, cuts my cost basis by $1.60 per share, or dropping it from $405.99 to $404.39. Now, that's for the month. But over the year, that would have been a reduction of $19.20, bringing my cost basis from $405.99 to $386.79, which is a much more comfortable position holding these Tesla shares. It's not much at first, but it absolutely adds up, narrowing the gap of my strike and my eventual appreciation. Plus, I'm betting that Tesla steadily rises up until Optimus, robo-taxes, and other catalysts, including tariff negotiations and whatnot, so that I can start selling much more aggressive options, collecting my 2+% premium at a later time. Tesla announced earnings after the bell that same exact day. I didn't care much about the numbers. Usually I would, because I was expecting a weaker quarter. The market, though, gave Tesla a boost, and for me, this specific earnings did not sway my options decision one way or the other. I couldn't care less. On May 1st, today, Tesla is currently trading at $282.40, up from my $261-ish when I sold these options. And my delta moved from below 1 to currently a 14, which makes me very comfortable, with an 86% chance of expiring worthless by May 16th. Now the question is, how do you get your strike price? Besides for the deltas and the expiration and so on and so forth, if I want to keep my shares and I'm taking a risk to sell options below my cost basis, and if assigned still below my cost basis, I want to almost guarantee, or as much as possible, that these shares don't get assigned, or worst case scenario, I'm able to roll. So I use something called technical analysis. I'm going to show you a screen right now, and I want you to understand There's something called moving averages. There's a 20-day moving average, a 50-day moving average, a 100-day moving average, and a 200-day moving average. And you're also going to be something called the Bollinger Bands. There's a lower Bollinger Band and an upper Bollinger Band, and that's 2 standard deviation of price movements. Essentially, the technicals is the Bollinger Bands just shows you where the possible it can go up. If it's outside of the Bollinger Bands, it means that it's overbought. And if it's below the Bollinger Bands, it could be oversold. You use that with the moving averages and a bunch of other technical analysis. Check out this chart right here. On April 22nd, the yellow highlighted dot shows a red line. That's a 200-day moving average at $292. Make sure you take that little bubble, and I put an arrow to show you the price so that you can follow. And the thin line, that's the top of the Bollinger Band at $299. Let's call them roughly $300, which is strong support. This white thick line is an extremely important line. That's the 100-day moving average, and that is currently at $333, hence where I'm getting this number of $330. I picked $330 as my strike, giving me some room for appreciation if a China deal or rate cuts hit. The 20 and the 50-day moving averages were above $261, hinting at a bottom or more pain. But I saw a rally coming with tariff talks and economic data pointing to rate cuts. The job data, inflation is going down. We have an FOMC meeting coming over here. Trump tariff talks and negotiations, so on and so forth. So I prioritized tactics over greed using these indicators. So my $330 cost basis is based on this technical analysis indicators. The arrows on the screen connect the highlights to the price action, so make sure that you're following and pay attention. And if you have any questions, I think I am very good at answering people's questions and breaking things down, so please ask down below. Also, I have a mailing list. Sign up to the mailing list. A lot of people have been asking me for a course or coaching or something like that. I'm going to announce something shortly. It's going to be a webinar, and seats are going to be limited. Please sign up to the email list down below so you don't miss the announcement coming up in the future. Also, there are other indicators that I use, but I won't go over those today. This is great for people in the videos first getting acquainted with technical analysis. If Tesla keeps rising, I'll just roll out and up, rinse and repeat. I'm confident that I'll get the strike price above my cost basis eventually, especially with compression from premiums collected. More likely, I think this will expire. Worthless, and I'll just sell a more aggressive covered call next time. This play squeezes every single ounce of appreciation. You're getting paid to wait. So cold, when life gives you lemon, you make lemonade. Kind of that analogy. Here's where I stand with this Tesla play. At $282.40 today, I'm still at $405.99 minus my $282.40, a $123.59 underwater. But with that $320 premium, I shaved off $1.60 per share off my cost basis. So now my cost basis is $404.39. I actually sold some covered calls besides for this ones in the video earlier, last month and the month before, but I won't share it today. So my cost base is actually lower than this, but let's just keep it at $404.39. My $330 strike is out of the money, and at a 14 delta, I've got an 86% chance of keeping my shares by May 16th. I got roughly 2 weeks left. If Tesla rallies to 330, I'll just roll out and up, rinse and repeat. I'm confident I'll get the strike price above my cost basis eventually, especially with the compression from the premiums collected. More likely, I think this will expire worthless, and I'll sell a more aggressive covered call next time. I'm betting on the rally I anticipated, and so far it's playing out. The cost basis compression play proves you can turn a losing position into a winning strategy with patience and technicals, perfect for veterans managing underwater stocks. But the key word here is a strategy. Many different techniques put together is a strategy for your overall portfolio and your overall game. Everybody's game is completely different. What works for me might not work for you, and what works for you might not work for me. The cost basis compression play with Tesla, it's a bold move to reduce your cost basis. when underwater using technicals to pick strikes and rolling to protect shares. Whether you're retired like me working a 9 to 5 job or saving for goals, start with the basics. A 20 delta, 4 to 6 weeks out, 2% monthly, and then expand the tactics like this to gain confidence. If you're unfamiliar with how to sell options, just click on the link right here. It's a playlist on everything options so that you can become a pro like me. I'm not a financial advisor. This is not advice, just my plays. So drop your questions down below in the comments. Make sure you sign up to the email list. I'm active here and I love your input. See you in the next one.